Hey everyone, Paul Clark here with TakingStockInvesting.com, and in this video I want to walk through why investing when the stock market or a specific stock is actually crashing is actually a really great time to get started with investing. That can be an opportunity where you're able to make a lot of money, and in fact I want to walk through a very specific example about how if you are investing over a long time horizon in a stock that is going to be continuously increasing by a certain amount, about how you can actually be making a lot more money by investing in a stock that crashes and eventually does recover a little bit, but doesn't even recover back to that initial price you bought it before it crashed. I mean, and that sounds really counterintuitive, but I think it's really powerful, and I think it's something that if you fully understand, it can help alleviate some of the fears of some of the short-term downturns. And I think even more than that, it can help you get excited that if you actually are investing in a stock that you believe in and you think is reputable, you understand that, based on your expectation that it's going to be around in the next 5-10 years or longer, that again, you should be welcoming opportunities to be buying this stock at lower prices. So, again, think about companies like a Disney World or, Disney, thinking about companies like a Walmart or Amazon. I mean, companies that have a very high likelihood of actually still being around in 5 or 10 years from now. You should be very excited about being able to buy them at a discount today. And I'm going to walk through specific examples and show you why that actually is the case. Now, the article that I'm going to be talking about is actually posted on TakingStockInvesting.com. I do think that this video format can help me go into a little bit more depth, and it can help me kind of walk over the actual spreadsheet and show you some different examples about why this actually is the case. Because again, this is not intuitive. This is not something that you would necessarily expect. And in fact, when I'm actually going to kick off with this example here, I'm going to kind of show you something that, just would scream to you that one stock would absolutely be the one that you'd want to invest in over time, when in fact it's really the other one that you would want to be owning. So with that being said, I'm going to go ahead and share my screen. So let's get into the example, and I can show you a little bit more detail about what I actually am talking about with this. Okay, so this is the actual example I was talking about. In this particular instance, we have, let's just assume that there's two scenarios for the exact same stock. So I'm just going to call it XYZ stock. And in one scenario, we have the table above, where we're just going to assume that the stock is steadily increasing in price over time. And in the second example, we're going to assume that this stock at some point actually crashes in price, recovers a little bit, but doesn't actually ever get back to the price it was at before that it crashed, right? So in this example, we're going to assume that this goes on for 8 years. So we're going to assume 2021 to 2028. So like, let's say you're going to start investing next year. And, with it, there's some things over here to call out. So, one of the things is that the very first example where the stock is steadily increasing, we see that the price of the stock started out at $50 in 2021, let's say, and at the end of our horizon here in 2028, it ends up being worth $65.80 by being able to grow 4% every single year. So that led to a total increase of 32%. So from 65.80 to 50 is an increase of 32%. Example number 2, it also starts out at $50, same XYZ stock, but again, the scenario where it crashes. Starts out at $50, actually increases in price a little bit. So by the next year, it's actually outpacing the scenario 1 where it's steadily increasing. So it picks up the pace a little bit here, and then it just dramatically falls off a cliff. It goes from 55 to 25 from the next year, continues to fall, tries to rally a little bit here, pulls back again a little bit, and then finishes out the last 2 years by, again, recovering certainly relative to the crash, but never actually gets back beyond that initial purchase price of $50. So let's say it ends up at $40. So in this particular case, you would actually be looking at a total decrease of 20% from the starting point to the ending point, from the $50 to the $40, right? Now, so again, just by looking at these two examples, you might be thinking to yourself, well, which stock would you want to actually be investing in, right? The one where you're steadily increasing, or the one where the stock is actually crashing? And visually, I feel like, it should just, every bone in your body should be screaming that you should want to be investing and putting your money in the one where it's actually steadily increasing over time. And that just, again, that would be my intuition by looking at this. I think that certainly a lot of people looking at this might be able to be thinking that way. But what's so interesting about it is actually, if you were going to be investing the same amount of money, and that's the key point, but if every single year you're going to be saying, hey, I'm going to set aside $1,000 to invest each of these years, or, just making sure it's the same amount of money, you would be far better off by investing in this stock that crashed and never actually fully recovered to the price before the crash. So let's talk about why that is, right? Because again, I keep saying it, but that's just not intuitive. You wouldn't really expect it to be. You would feel like you would want to be investing in the stock that is increasing in price, of course. So why that works out, part of the answer is that we can look at the number of shares that you're able to purchase for these different stocks. So the stock that is steadily increasing over time, each year that goes by, the $1,000 that you want to consistently invest is actually able to buy less and less shares, right? So we see that declining over time. Whereas with the stock that crashed, when it did, crash here, you were able to buy dramatically more of the stock than what you were able to of the stock that was steadily increasing. And that becomes very, very key for why this is going to, in this particular example, outperform the stock that was increasing over time. And this is showing the shares that are purchased in every single year, but we can also start to think of this in terms of the shares that were purchased on a cumulative total. And a cumulative total, just to illustrate that, would mean, if we use this top example here, the number of shares that were purchased, if you're investing $1,000, if you're investing $1,000 at $50 a share, you're able to buy 20 shares. It's just the division of those two, the amount that you're investing and the current share price of the stock, right? So by the next year, so 2022 in this example, you were able to buy 19 shares. So if you add those both together, you now have 39 shares. So our cumulative would say by 2022, you have 39 cumulative shares, which is just equal to, just the sum total of all the shares through that point. And if we were able to actually add up all of these here, this would total to 140, which is exactly the sum that we have here in our cumulative total. So with that in mind, we can head over to our cumulative shares purchased and kind of look at that graphically. And we can see that, because we had this same, linear increase in the stock price for the stock that was steadily increasing, the amount of shares that you have are just increasing by the same amount every year. So we just see this really, clean straight line for the steady increase of the shares that you're able to own. And you end up again owning 140 shares. But with the cumulative shares purchased for the stock that actually crashed, we were able to buy way more shares. So we ended up with 290 shares of this stock, again, comparing that to the 140, but we're able to kind of see how that cumulative total changes over time. What we can also do here is then understand the cumulative value of that stock. And we do that in this example. Again, pretty simple. We could literally just say the total value of the cumulative stock at any given point in time is just looking at the actual price of the stock in that year and the total shares that you own. So by year one, let's say again, if the stock ended up at $50, you put $1,000 into it. Let's say the price didn't do anything. You end up owning 20 shares. It's $50. You have $1,000 worth of stock. And the second example, it's the exact same thing. Your starting point is at $50. You have $1,000 of the stock. And so you have $1,000 as your cumulative value of your shares. So those become the same. But then it changes by year two. By year two, and the stock that crashed, in just our made up example here, $50 to $55. And by doing that, we see that now we have 38 shares total. And if we multiply those 38 shares by the $55 for the most recent stock price in that year, we have $2,100, which is less than in this case because, the share price was able to increase by only $52 or to $52. Okay. And so we can see that changing over time, and we can also take a look at that graphically over here. So again, this is the cumulative value of the stock. So by 2023, when you're at this point, the stock that was steadily increasing is far beating the stock that crashed. By 2024, you would have the stock that's steadily increasing still way outperforming. 2025, that's true, 2026. But then in 2027, we would see that the cumulative value of the shares that crashed are now all of a sudden becoming more valuable, 2028 becoming more valuable. So this works out in this example. We can kind of see, the numbers up here. We could go ahead and just insert a variance column to show that as well. Let's do that. Let's expand it out. Okay. So at the lowest point, and we would be sitting in 2026 and we would be saying, hey, I thought you told me that a stock that was going to, decrease in value was actually going to be, a better scenario than a stock that was steadily increasing over time. And, I would say, hey, you're really close to that being true. It's just not entirely there yet, because by 2027, we can actually see that the stock that fell from $50 to 25 to 18 and then recovered to $35, again, far short of the 50, would actually be worth well over $1,000 more than the stock that ended up continuously increasing and went from 50 to 63. And then it becomes even more dramatic in 2028, because even though it's still $10 below the 50, that additional recovery here now pushes it to where it's well over $2,000 better to have stuck it out with a stock that crashed. So, all of this is really kind of to point out that if you actually are investing in a stock that you really believe in, you can actually be far better off by investing in that stock when there actually is a crash. All right. Thanks everyone for watching. Again, just a reminder that this article is available on takingstockinvesting.com. I'd love for you to check out the website. If you have any questions, you have any topics you'd like me to talk about in the future, go ahead and drop a comment and I'd love to get to it. Thanks.